Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. Today I've got a very special guest. His name is Mr. Karl Denninger. He has been featured on CNBC, MSNBC, the Glenn Beck program, as well as other venues where he has expressed political and economic opinions. But today we'll be focusing mainly on the markets and economics. I'm very privileged to be speaking with him today. Mr. Denninger, thank you for joining me.
Thank you for having me on.
Yeah, it's a privilege and a pleasure. And so today I wanted to talk about where the markets may be headed in the remainder of 2017. It's been up around, 10% or more since the election in November. That's called the Trump trade. Can it continue like this? Is it sustainable? What do you think?
Markets, in the longer term, it's said that they are a discounting mechanism on forward earnings prospects for companies. At least that's what they're supposed to be. In the shorter term, however, markets tend to be more of a speculative mechanism where people try to game out whether you're going to get good or bad things from a fiscal policy perspective, from a monetary policy perspective, sometimes from a geopolitical perspective. And I think there's a problem here because the response that started the night of the election, if you remember, we were way down when it was first discovered that Trump was going to win.
Right. And
then the market went roaring higher from there. So, I mean, we were lock limit at one point down on the futures the night of the election itself. And so that was a crazy swing. But what you've had priced in is not only manufacturing resurgence in the United States, but you could see that in stocks, for example, steel makers and things like this. But you've also seen priced in permanently low interest rates, and at the same time, a resolution of all of the trade disputes that we have in our favor, along with, at the same time, a large fiscal stimulus and a large set of tax cuts. Because that's essentially what Trump ran on. There's a problem with this in that a large tax cut that is not revenue neutral. If it is revenue neutral, then somebody is going to get hosed at the same time somebody gets benefit, right? So that's a net economic zero. But if you get a large tax cut without any kind of pay for, and at the same time, you have this infrastructure spending and all of these other fiscal programs, then the deficit's going to explode. And the problem with doing that is that you're going to create an awful lot of monetary inflation, and that's exactly the sort of thing that the Fed watches for and is at least in theory supposed to push against. So I think there's kind of been the all good and none of the bad sort of view that the market has taken towards Trump's presidency. And not only is that rather unlikely, but none of it's happened yet. So I think we're a little ahead of ourselves, and that's probably being kind.
Interesting perspective. Lately, it seems like Trump is warming up to Fed Chair Janet Yellen. I'm not saying they're best friends or anything like that, but he may be open to the idea of a more dovish monetary policy. Do you think this is real? Is this something that we'll see more of in the future?
I don't know. Janet Yellen, of course, is a dove to begin with. Her, along with Ben Bernanke, seem to think that the Federal Reserve can cure every economic ill that faces the country. Claims that they have a limit to their policy notwithstanding, they certainly don't show it. I think Trump is well aware that if rates were to normalize today, in other words, if we were to see the 10-year Treasury trading somewhere around 6 or 7%, the one-year T-bill trading around 4 or 5, you'd take the current deficit and put about $500 billion a year on it, just from the fact that the interest expense to the Treasury would go through the roof. So that's obviously a situation that in the current paradigm where we're taking on over $1 trillion a year worth of additional federal debt, we could not monetize. And it would rapidly turn into a situation where interest was the only thing we paid, which of course has some very bad economic effects. So I mean, Trump, if anything, is a realist. He's been in business for a long time, and he understands how interest rates work. And I'm sure that it didn't take him very long after getting into office to look at the size of the deficit and the size of the federal debt, and just take the debt and put a average coupon on that and figure out how much money you're going to have to spend.
I wanted to talk quickly about Denninger.net and market-ticker.org. What is the difference between these two websites, and what will people see when they visit?
Well, Denninger.net is my personal page. There are links to market-ticker.org there, but it's primarily the things that I enjoy doing. Market-ticker.org is a publication that I have run since 2007. I set it up primarily because I saw the same kind of stupidity going on in the 07 time frame that was going on in the 1998-1999 time frame after I sold my internet company, and felt that I had at least, if not a duty, a calling, if you will, to put some information out there for people, hopefully to keep them from getting hosed as badly as occurred to people in the 2000 crash. And I'd like to think that I helped some people out in 07, 08. Of course, since then, we've papered over all the problems, but we haven't actually fixed much of anything. And probably the most important of those today, and where I'm focusing a lot of my attention now and have for the last several years, is on the explosion of healthcare costs. That is the 900-pound gorilla in the china shop when it comes to the federal government as well as private industry. It's, in my opinion, the reason we have such terrible productivity growth. And in addition to that, if we don't do something about it, in the next 4 or 5 years, it's going to collapse the federal budget. So this is not a thing that we can kind of kick the can on and say, well, we'll deal with it later, because we've done that for 30 years, and the later is now.
If people are looking to hedge right now, or if they're just a little bit, let's say, bearish or skittish on the markets right now, what should they be looking at? Should it be gold, silver, physical, ETFs? What would you recommend?
Well, I don't give personalized advice because I can't. That's illegal to do without the appropriate license.
Disclaimer:
but,
we're not making recommendations of any sort.
Yeah,
but given that,
I think you have to look at the market today and say, by any measure you care to use, valuations are extremely rich. Commodities, particularly gold and silver, are a nice geopolitical risk hedge and have always worked well as a geopolitical risk hedge. However, they are a terrible inflation hedge on a comparative basis. If you take a look at gold from 1980s to today versus the S&P 500, it's very obvious which of the two you wanted to be in, and it wasn't gold. So there's a real problem with trying to hide in physical metals. Now, if you think that the government of the United States is going to fail, then maybe that might be a different situation. But then the question becomes, how do you use that? How do you use that gold? And people in the Depression found that out when FDR, of course, made it illegal, and almost nobody actually turned it in. However, you couldn't spend it for 30 or 40 years. Well, what good does that do you? You're going to be dead by then. So I tend to think that at times like this, if you're bearish or if you're concerned, you either buy protection because it's quite cheap right now, which you can do in the options market, or you just go to cash. And for those people that think that cash is trash, well, in the 2006-07 time frame, when the dollar index was down around trading in the 70s, I thought there was a real possibility it was going to 40. Of course, it didn't happen. And when the reversal came, I had to look at my thesis and say, okay, what did I get wrong on this? And the answer is I got a lot of things wrong. But you look at where the dollar is now. If you bought it when it was at 70, well, gee, it's trading at 100. That's a pretty good gain. So who's complaining about a 40% improvement in the space of that much time comparatively speaking? It's a risk-free asset, supposedly, right?
Supposedly. Right, I hear you. You've mentioned, I'm reading right off your blog, market-ticker.org. Fascinating blog. Everybody should check it out. I'm reading right now. You've mentioned that the 30-year trend in Medicare and Medicaid spending will not be stopped. Are there any implications for healthcare stocks or just the healthcare sector as a whole right now that's actionable for traders and investors?
There's a number of them, and they're very important to pay attention to. If the government does not put a stop to the monopolies and the game playing in that sector, and to put a quantifying figure on this, healthcare historically in this country was about 3% of GDP. Today it is better than 19%, and Medicare and Medicaid are expanding approximately 9% a year. The PPACA, that's Obamacare, halted that expansion for 1 year, after which it went right back to where it was. And it's not all Medicare either. Medicare, of course, is for old people. Medicaid is for poor people. When you get old, whether you're poor or not, you go on Medicare. The increase in percentage terms has been almost identical between those two. They're statistically the same. So the idea that this is all about Americans getting older is just a lie. The reality is that if we were to take that system and fix it, it would go back to being about 3 to 4% of GDP. That, of course, would be an enormous recession. There'd be about a 15% contraction in GDP over the short term until the economy reallocated those resources somewhere else. I think you can figure out how much people would like to do that in the government, right, in terms of actually intentionally causing a 15% contraction in gross domestic product. But if we don't do it, then the situation we're going to find ourselves in is that when the government cannot finance this continued expansion at a rate of 3 to 4 times what the economy is expanding, they're going to have to forcibly cut people off. And the low-hanging fruit in this area, from my analysis, says it's in type 2 diabetes. So if you're looking at where this comes from, assuming that the government does not do the right thing, and I don't expect them to, if you personally are overweight or obese, you better fix that right now. And the way you fix that without drugs is you stop eating carbohydrates.
Okay. I imagine exercise wouldn't hurt either, but there you go.
Well, exercise doesn't hurt, but you cannot outrun your fork. That's just simple math. So, I mean, running a mile is about 100 calories.
Right.
And a pound of weight is about 3,300. So unless you're planning on running better than a marathon every day,
yep.
Yeah.
Excellent points there. Very good, sir. Just a couple more questions, if I may, because I know your time is very valuable. Just a kind of a quasi personal question. Are you a stacker of gold, silver, or other precious metals, and why or why not?
No, I hold no physical commodities of any kind, and the reason is that history has shown that if things really get awful, which is the time that those would be valuable, the cost of the next chicken you want to eat is going to be however much gold you have. Same thing with wanting to get across the bridge where you have a guard and he's got a gun. How much is the toll and how much gold you got?
Right.
So in that situation, I don't think it's worth much of anything except maybe to have a couple of coins sewed in your, the lapel of your jacket to bribe somebody with. And in other cases, when I look at the history of the metals, I just don't see the correlation. The only time that I see them really responding well in a way that's very protective is if there's severe geopolitical risk. The last time we had that happen was during the Iranian hostage crisis. And today, if we have that kind of geopolitical risk rear its head, unfortunately, we live in a world where people lob canned sunshine around. So I think the probability of winding up with a bunch of metal that's molten next to your bones is a little too high for my taste.
So I'm just curious, what products do you keep by your side in case it all goes to where in a handbasket, if not gold or silver?
Well, I think what you have to keep is the means of producing enough to be okay, which means you need somewhere to go. You cannot be in a large city. You need some means of producing and having food. It's a lot harder than it looks. And the reality is that we live in a just-in-time world. So if you live in a large community, a large city, you've got so many other problems that whether you're holding physical commodities is way down the list if things really get ugly.
Makes sense to me. And finally, one more, if I may. Again, we're certainly not giving out investment or trading advisement here, but are there any stocks, sectors, or industries that investors should be looking at that they're probably not right now?
I don't think so. My biggest problem right now is everything looks expensive. The stuff that's cheap is cheap for a good reason. You look at the automakers, for example. They're cheap for a reason. Okay, you have autos rolling over right now, and credit quality and everything else. And the stuff that's expensive is crazy expensive. Technology sounds attractive until you start looking at the multiples and see these companies like Amazon, 1,000 times earnings, and Facebook at 150, and no matter where you look, it just looks nuts. And I see an awful lot of the unicorn kind of thing going on again, especially in companies like Netflix, where the company's got negative free cash flow. That only goes on until people in the market decide that they're not going to fund it anymore. And that sounds an awful lot like 1999. I remember how that show ended, and it was pretty ugly.
I was there too, and it was terrible. Mr. Karl Denninger joined me today. Fascinating, so much to think about. And I just wanted to mention your websites and give you an opportunity to speak about that one more time. Market-ticker.org, as well as Denninger, DENNINGER.net. I will put those links in the description of the video. Are there any other sites or social media profiles or services you'd like to mention to everybody right now?
Well, I'm on Twitter as Ticker Guy, so if you want to take a look at all the stuff I post on the Market Ticker shows up there, and I tend to put some quick hit 140 character comments out every now and then on things that I see there as well. So that's another way to kind of keep track of things if you don't want to point an RSS reader at the page or something along that line.
Fantastic. So we've got Twitter as well as your two sites that people definitely need to check out right now. Mr. Denninger, you're a fascinating individual. Thank you so much for offering us a little bit of your insight today.
Thank you very much for having me.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.